Hey everyone, welcome back to Financial Futures. Today we've got some big news that could shake up the financial markets. The latest government report just dropped, showing that headline inflation is at 2.9% year over year. Core inflation, which excludes those volatile food and energy prices, is sitting at 3.2%. So, what does this mean for your money, and what can we expect the Federal Reserve to do next? Let's break it all down. So, this morning, the government released the latest inflation numbers. Headline inflation is at 2.9%, and core inflation again, that's the figure that strips out food and energy, rose by 3.2% year over year. This is actually the smallest 12-month increase we've seen since April 2021. Now, I know you're probably wondering, what does this all mean for interest rates and your wallet? Well, let me tell you, it could mean a lot, especially come September 18th, when the Federal Reserve meets next. Now, here's the big takeaway. With these inflation numbers not looking like a disaster, the Federal Reserve is almost certainly going to cut interest rates at their September meeting. I mentioned a few days ago that if this inflation report didn't come in as a shocker, it wouldn't derail the Fed's plans to pivot towards easing. Well, that's exactly what's happening. The report wasn't a disaster, so we're now looking at a rate cut. It's just a matter of whether it's going to be 25 or 50 basis points. Let's look at the market expectations according to the CME FedWatch tool. There's currently a 43.5% chance of a 50 basis point cut and a 56.5% chance of a 25 basis point cut. Just so you know, before this report, those odds were flipped. Now, the probability of a rate cut at the next FOMC meeting is at a whopping 100%. The only question now is, how much will they cut? Personally, I was betting on a 25 basis point cut, and it seems like the market is leaning that way too. But what do you think? Drop your thoughts in the comments below. But that's not all. The market is also expecting another rate cut in November, and again in December. That means we could see 3 more rate cuts before the year's end. However, I have to say, 3 rate cuts in 3 meetings might be a bit too aggressive. It's all going to depend on the labor market, which brings us to the next big date to watch, September 6, when the jobs report comes out. If we see the labor market weaken and unemployment rise above the current 4.3%, that could be the final green light for the Fed to go ahead with those cuts. So, why am I so confident that the Fed will cut rates? Just listen to what they're saying. Jerome Powell and several other Fed members, like Susan Collins from Boston and Jeff Schmid from Kansas City, have all hinted that if inflation continues on this path, it will be appropriate to start easing monetary policy. They're practically telling us what's going to happen. Even Fed Governor Michelle Bowman has said that if inflation keeps moving towards their 2% goal, it will make sense to gradually lower rates to avoid over-restricting the economy. Now, let's talk about the problem areas in this report. Shelter inflation is still stubbornly high at 5.1%. It only dropped slightly from 5.2% last month. That's not good news, especially when you consider that the Fed's target is 2%. Shelter costs are a huge component of overall inflation, and they actually accelerated month over month. So, while headline and core inflation are moving in the right direction, the cost of housing remains a serious issue. I know a lot of you have been saying the housing market has already crashed, but if that were true, wouldn't housing more affordable? If you think prices have crashed, I'd challenge you to go buy a house right now. Let me know how that works out. Here are some quick highlights from the report. Food prices are up by 2.2% year over year, with eggs spiking by 19.1%, butter up 6.1%, and meats up 3.1%. On the flip side, fruits and veggies are down by 0.2%, coffee is down 0.4%, and bread is down 0.9%. Energy prices saw a slight increase of 1.1%, with electricity up 4.9% and utility gas up 1.5%. Gasoline, however, is down by 2.2%. These numbers give us a mixed bag of inflationary pressures, but overall, it seems like the Fed is getting what it wants slowly but surely. Before we wrap up, I want to share one last piece of info. The Fed's microeconomic report, released just 2 days ago, shows that inflation expectations have dropped sharply. Americans now expect inflation to persist at 2.3%, the lowest since June 2013. But here's the kicker: households expect their income to grow by 3% over the next year, while their expenses are expected to rise by 4.9%. That's a pretty big gap, and it's not exactly good news when your expenses outpace your income. Plus, the probability of missing a minimum debt payment has risen to 13.3%, the highest since April 2020. So, while inflation might be cooling, the financial stress on households is still very real. So, there you have it, a lot to unpack, but I hope this helps you understand what's going on with inflation, interest rates, and what to watch for in the coming weeks. If you found this video helpful, be sure to hit that like button, subscribe to Financial Futures, and share this video with anyone who needs to stay informed. Your support helps us keep bringing you the latest financial insights. Thanks for watching, and I'll see you in the next video.